Financial analysis using ratios. In this presentation, I will discuss two companies, Domino's and Papa John's. I will first give a bit of background about the two companies and some information on the industry they operate in. Next, I will compare them using financial ratios and explain what these ratios mean. Finally, I will give my thoughts on which company I would invest in if I were investing in either of these companies. So let's dive into a little bit of background information on these two companies and the industry they operate in. The industry that these two companies operate in is the restaurant industry, more specifically in the pizza chain industry. This industry is projected to grow by 2.8% between 2025 and 2035. In fact, it has been reported that over 70% of consumers prefer pizza from a restaurant over frozen pizza, giving these companies an advantage over pizza brands such as DiGiorno or Celeste. As of 2024, chain-operated pizza restaurants produced $50 billion in annual revenue just in the U.S. alone, and had over 75,000 locations around the world. The pizza industry is also a highly competitive industry, making it crucial for companies to stay creative in making new products, attracting new customers, and finding ways to keep these customers returning. A bit of background information on Domino's. Domino's primarily offers and pushes the sales of their pizza. However, they also offer many other food products, including pasta, sandwiches, and chicken wings. Domino's operates in over 90 different markets internationally with over 21,500 stores. Over 7,000 of those stores are located in the United States. While the company does have some corporate-owned locations, they primarily operate as franchise locations. The company's targeted demographic includes both individuals and families, those looking for a quick and affordable lunch or dinner option, and those who are in need of a delivery food option. For example, this could include students who are away at school without a vehicle and want an affordable dinner option, or a busy mom who is working late and needs dinner ready when she gets home with the family. Now for a little bit about Papa John's, who is very similar to Domino's. Papa John's also primarily offers and pushes the sales of their pizza. However, they also offer other food options, including chicken wings and their papadillas, which is their take on a pizza meets quesadilla. Papa John's operates in about 50 different countries with over 6,000 locations. Over 3,500 of those stores are in the United States. While the company does have some corporate-owned stores, as of 2019, it was estimated that about 89% of their store locations were franchise-owned. The company's targeted demographic is similar to Domino's, which includes both individuals and families, those looking for a quick and affordable lunch or dinner option, and those who are in need of a delivery food option. Both restaurants rely on discretionary spending, which is when consumers spend on items that are not necessities. Though this type of spending can take a drastic decrease in times of economic recession, the demand for the products these companies offer remains consistent since their products are aimed towards those looking for a cheaper takeout option. Domino's online ordering service has helped the company steadily grow in recent years. While Papa John's has also seen growth, it has not happened as rapidly as Domino's. Recently, Papa John's has used promotions on their menu items to keep customers returning in order to prevent decrease in sales. Papa John's also uses premium ingredients, which can cause the company to be impacted more in times of higher inflation since their cost to produce these goods may be higher and customers may not be willing to pay for this product during these times. Now let's dive into the financial assessment of these two companies. I will discuss profitability, asset management, liquidity, debt management, and market value ratios. I will discuss the various ratios in each of these categories, what they mean, and which company has a more favorable ratio. Profitability ratios illustrate to the business and investors how well the company is profiting from their sales. Various ratios make up the category of profitability ratios. These can include the operating margin, gross profit margin, return on total assets, basic earning power, and return on common equity. The operating margin describes how much profit remains after operating expenses have been paid. We are looking for a higher operating margin since it means more profit is left over from revenue after operating expenses are deducted. Here, Domino's has a more favorable operating margin, earning 19 cents per dollar of sales, while Papa John's is only earning 7 cents per dollar of sales. The gross profit margin describes how much profit remains after cost of goods sold is deducted. In this case, the cost of goods sold would be the cost of the food or pizza ingredients. We are looking for a higher gross profit margin since it means more profit is left over from revenue after paying for the cost of the ingredients to make the food being sold. Here, Domino's has a more favorable gross profit margin, having kept 39.28% of each sale, compared to Papa John's only keeping 25.36% of each sale. The return on total assets ratio describes how well a company is using their assets in order to generate profit. We are looking for a higher return on total assets, since it means assets are being used more efficiently to produce profits. Here, Domino's has a higher return on total assets, showing that this company is using their assets much more efficiently than Papa John's is in order to generate profit. Basic earning power looks at how well a company is operating without any taxes or financing costs like interest included. Here, Domino's has a higher basic earning power compared to Papa John's, displaying that Domino's is operating much more efficiently than Papa John's. Return on common equity describes how much a company is profiting by using shareholder investment. Here, both are negative values, suggesting that they're not using shareholder equity to their advantage, but Domino's would be more favorable since it is losing less on investments. Asset management ratios illustrate how efficiently the company is using their assets. Various ratios make up the category of asset management ratios. These can include the inventory turnover ratio, days sales outstanding, fixed asset turnover ratio, and the total asset turnover ratio. The inventory turnover ratio describes how quickly inventory is being sold. We are looking for a higher inventory turnover ratio since it indicates the business is using their inventory more quickly, in this case, food and pizza ingredients. Here, Papa John's has the more favorable inventory turnover ratio, showing that they use and sell their inventory a bit faster than Domino's is using and selling theirs. The day sales outstanding describes the average time it takes the company to collect from customers. We are looking for a lower day sales outstanding because it means the company is able to collect what is owed to them faster. Here, Papa John's has the more favorable day sales outstanding since they are able to collect in about 19.29 days, compared to Domino's, who's a bit slower, taking 23.97 days. The fixed asset turnover ratio describes how well the company is using their fixed assets, such as property and equipment, to generate sales. We are looking for a higher fixed asset turnover ratio since it indicates that the business is using their fixed assets more efficiently to produce sales. Here, Domino's has a higher fixed asset turnover ratio, indicating that the use of their property and equipment is more efficient than Papa John's in generating sales. The total asset turnover ratio describes how well the company is using all of its assets to generate sales. We are looking for a higher total asset turnover ratio since it means that the company is using all of their assets to generate sales in a more efficient way. Here, Domino's has a higher total asset turnover ratio, indicating that they are using all of their assets a bit more efficiently than Papa John's is to produce sales. Liquidity ratios illustrate a company's ability to pay short-term debts. This can include the current ratio and quick ratio. The current ratio compares current assets to short-term liabilities to assess the company's ability to pay these liabilities. We are looking for a higher current ratio because it indicates that the company has more of an ability to pay off these current liabilities. A current ratio of greater than 1 would indicate that the company has enough current assets to pay for their short-term liabilities. Here, both companies have a current ratio of less than 1, indicating that both of their current liabilities are greater than their current assets. The more favorable current ratio is Papa John's since it is greater than Domino's and closer to having enough assets to cover liabilities. The quick ratio looks at the same comparison as the current ratio, however, inventory is not included in the current assets. We are looking for a higher quick ratio because again it indicates that the company has more of an ability to pay off the current liabilities. Here, Papa John's has the higher quick ratio, indicating they have more of an ability to pay off short-term debts with current assets, however not including inventory. Debt management ratios illustrate how much a company relies on debt to finance their assets. These ratios can include the total debt to assets ratio and the times interest earned ratio. The total debt to total assets ratio describes how much a company's assets are financed through debt. We are looking for a lower total debt to total assets ratio because it means the company is relying less on debt and more on their own equity to pay for their assets. Here, Papa John's has a more favorable total debt to total assets ratio, indicating they are paying for their assets with more equity and less debt. The times interest earned ratio describes the company's ability to pay interest payments. We are looking for a higher times interest earned ratio because it indicates that the company has a better ability to pay these interest payments. Here, Domino's has the more favorable times interest earned ratio, showing that they are able to pay interest payments a bit better than Papa John's is able to. Market value ratios compare stock prices to financial performance of the company. These ratios could include the price to earnings ratio and the market to book ratio. The price to earnings ratio describes how much investors are willing to pay compared to each dollar of earnings. We are looking for a higher price to earnings ratio because it indicates that investors are willing to pay more for each dollar. Here, Domino's has a more favorable price to earnings ratio since investors are willing to pay $24.11 for each dollar of earnings compared to Papa John's investors only willing to pay $15.59 for each dollar of earnings. The market to book ratio compares what investors think a company is worth to what it's actually worth in the books. We are looking for a higher market to book ratio, preferably above 1, because it indicates that investors view the company as more valuable. If the ratio is above 1, it means investors view the company as more valuable than it is on the books. Here, both companies are negative, indicating that investors believe both companies are less valuable than their book values. The more favorable market to book ratio would be Papa John's, since it is higher and indicates investors feel the value is closer to the book value than with Domino's. After learning all the information about these companies, the industry, and how each is performing financially, which would you choose if you had the opportunity to invest in either of these two companies? If I were to invest in either of these companies, it would be Domino's. Domino's has a higher profitability ratios across the board, pointing to a company that is profiting more from their sales. Domino's also has a higher asset turnover ratios, meaning that they are using their assets more effectively than Papa John's is to generate sales. Combined with the increased profitability, this is more money that Domino's is able to use to pay off liabilities or put into the continued growth of the company. Finally, Domino's has a much higher price-to-earnings ratio than Papa John's, indicating that investors value this company more than they value Papa John's. Between the size of the company, its continued growth over time, and these more favorable ratios, it is clear that Domino's is the better choice to invest.